Terry Ryder from hotspotting.com.au, bringing you today's edition of my positive news bulletin on a day in which more states announced the easing of restrictions and around 2.5 million Australians have downloaded the tracing app. Now, today we heard from renowned real estate educator Peter Kaluzos, otherwise known as the Property Professor, who is the chairman of the Property Investment Professionals of Australia, or PIPA. Now, Kaluzos says that most major property markets around the nation are well placed to withstand the coronavirus shutdown period. He says the many financial support programs available will help to prevent any significant property price falls over the medium term. Kaluzos says whenever there is a global financial shock, some commentators predict huge property price falls, which ultimately don't happen. He notes that during the GFC in 2008, prices were forecast by some to fall by 30 or 40% or more, and in many locations they held their ground and even strengthened over the months that followed, and then rose strongly in both 2009 and 2010. Kaluzos says, while the coronavirus situation is somewhat different, given that it's a temporary public health emergency, I believe property prices may temporarily soften by 5 to 10% at most, but rebound relatively quickly. Kaluzos says most property markets were experiencing strong conditions prior to the pandemic, which would help to insulate them over coming months. Compared to other economic downturns, existing low interest rates and inflation will also protect property markets, he said. And to that, I would add that vacancies were low in most markets around the nation, which will help most of these places absorb the new stock coming to the market, because those who use short-term tenancy options like Airbnb are now putting their properties into the permanent rental pool. Now, so far, there's little evidence of price decline in the major markets around the country. CoreLogic has published a report showing that 3/4 of the way through April, there's been actually a small rise in national property values for the month so far. More on that later. But keeping in mind that many media reports at the start of this month claim that the positive price results recorded in March were irrelevant, and that by now, towards the end of April, we will be seeing graphic evidence of a major decline in property values. Well, we haven't, not according to the latest CoreLogic figures. And also, today, we saw the publication of the latest data on prices from SQM Research. Its rolling monthly price index, which brings us right up to the present day, shows that this month there has been a small rise, 0.4% nationally, in property prices so far this month. As I commented yesterday, any rise in the price indexes in the current circumstances is remarkable. The SQM figures for April show a 0.4% monthly rise for Sydney and a 0.7% rise for Melbourne, and also a 0.7% rise for Darwin. Now, there's growing evidence of solid buying activity around the country by first home buyers. First timers have the federal scheme now operating, which means they can buy with a deposit of just 5% without needing to pay for lenders' mortgage insurance, in addition to the state government supports that's available in most states, at a time when interest rates are ultra low and there's not a lot of competition from other buyers. All this means that first home buyers can buy their first home easier and faster than before. Of the 10,000 places available under the federal scheme, which started on 1 January, the latest statistics from the Federal Minister for Housing show that nationally, 4,147 certificates have been issued for those who have already bought a property, and a further 3,909 places are on hold waiting for the purchase of a property to be settled, while only 1,944 places are still available. However, they may not be around for much longer, with applications by 27 different lenders still being worked through, according to the reports today. Now, 4040 Finance Director and Mortgage Broker Will Uncles says he has been busier than ever helping first-home buyers with their loans despite the impacts of social distancing on the market. Now, turning to a report from Domain, it's forecasting that house prices in some of Australia's regional towns are poised to keep growing. Why? Well, because, as I have commented in previous editions, the coronavirus pandemic is prompting city dwellers to consider a lifestyle change. Those forced to work from home may decide to make it a permanent arrangement if they can, and that will create increased demand for homes in regional areas near major cities. At the same time, some mining towns have also recorded strong house price growth in the past year, and with the resources industry considered essential, the growth may continue if more job seekers move there. Although I think it's more likely we will see price rises in regional centres that are major sources of workers who fly in, fly out, or drive in, drive out to their jobs in the resources sector. Some locations in central Queensland, like Mackay and Rockhampton, are likely targets, and I've reported in recent days that rents in these places are actually rising because of increased demand from workers in the resources sector. Now, Domain Senior Research Analyst Nicola Powell says this shift of people moving from capitals to regional areas, we're seeing it anyway as our capitals become overpriced. But because of COVID, we're all taking the time to pause in our life. We're looking at lifestyle, we're looking at affordability, and people may be more so looking to make that tree change or sea change. Decentralisation of the workforce could come into focus as businesses realise that many staff members are able to work from home, which cuts their office costs, she says. And with agriculture and mining areas likely to hold up better during this period, those who have lost jobs in the city may move to these regions looking for work. And I agree with pretty much all of that. With many of these regular positive news bulletins, I've been highlighting some of the sales that have been achieved at online auctions, now that we can't have normal ones, with sale prices in some cases well above the reserve. So here's another one, a home in Strathfield in Sydney, which sold for $2.7 million after a 10-day marketing campaign, and that sale price was $200,000 above the reserve. There have been news this week about expats living in offshore cities like Hong Kong and Singapore seeking to buy back into Australia ahead of returning home. Brisbane in particular is proving popular with Hong Kong buyers and expats who are re-evaluating their circumstances due to the coronavirus, while Sydney is also attracting Singapore-based expats. Economic uncertainty, the closure of state borders, and encouragement from the federal government to return has overseas buyers looking to put their money into the Australian residential market. Many agents argue that there's no better time to do just that, with the low Australian dollar and record low interest rates proving an attractive value proposition. Brisbane's relative affordability compared to Sydney and Melbourne has helped give it an edge with expats, while flexible workplaces help orient them away from major financial hubs such as the larger East Coast cities. Buyer's agent Michael Cleary, he says he is looking to make 17 deals in Brisbane, with inquiry increasing significantly in the past few weeks. Cleary says the popularity of Brisbane has grown over the past 18 months as buyers find value in the affordable and maturing capital city. Now, turning to some of the latest stimulus measures that are being announced. And cash-strapped local councils in New South Wales have been given a financial lifeline for community projects and to keep their staff on. For example, the Tamworth Council, along with Armidale and others, is impacted by the COVID-19 pandemic, with events cancelled, parks and attractions closed, tourism down, and galleries and event centres not operating. The councils have also suffered losses at their local airports. So the New South Wales government has tipped almost $400 million into local councils for community infrastructure projects and for relief with their wages bills. As part of the council stimulus package, the government has pledged an additional $250 million in low-cost loans to spur community infrastructure investment, and also more than $110 million on a job retention fund for council workers. The council job retention allowance of $1,500 per fortnight will be paid for up to 3 months to eligible staff in the New South Wales local government sector, because council workers are not granted access to the federal government's JobKeeper program for some reason. Also in New South Wales, the state government is planning a $500 million property spending spree, with the idea of buying unsold apartments and also fast-tracking construction of others as a part of a economic recovery plan. A cabinet briefing paper prepared by the government's Land and Housing Corporation says a housing-focused stimulus package would accelerate development and boost employment in New South Wales. It recommends a three-staged approach, which would include $160 million worth of shovel-ready projects, which could see construction of 300 social housing dwellings to start soon. And another 360 dwellings could be underway within the next 5 or 6 months with $190 million in funding, and the third $200 million stage would be for housing for people displaced as a result of COVID-19. The paper identifies 8 developments which already have approval in local government areas in Sydney, including Canterbury, Bankstown, Liverpool and also Newcastle, as well as projects that include opportunities to purchase dwellings off the plan. It lists several projects in Parramatta, Westmead and South Granville where the government could negotiate with the developer to buy dozens of unsold apartments. And this would be timely because the construction industry has joined with charities and welfare groups to push for a post-COVID-19 social housing boom to stimulate the economy, create more jobs and head off a potential increase in homelessness. The nation's leaders are being urged to prioritise large-scale home building investments in the months ahead to help aid economic recovery by incentivising new investment in the market and maintaining and upgrading existing social housing. The Master Builders Association has urged governments and the private sector to partner to fill the gap as market demand softens, saying the way out of COVID-19 could be accelerated by investment into affordable housing supply. In Melbourne, the Building Victoria's Recovery Task Force will be overseen by Planning and Housing Minister Richard Wynne and the Treasurer Tim Pellis, as well as senior business leaders. The task force will have the responsibility of investigating opportunity to boost Victoria's building and development industry over the short, medium and long term. And Wynne says this task force will help ensure the building and development industry is the driving force or a driving force for Victoria's economy through this pandemic and beyond. It will help deliver existing projects more efficiently and assist new projects get off the ground faster. Also in Melbourne, the last 2 tunnel boring machines on the Metro Tunnel project are now on the ground, helping to build the state's biggest public transport project and keep Victorians in work. The third boring machine, which is known as Millie, is digging the first 1.7 kilometre tunnel between Anzac Station and the Metro Tunnel's eastern entrance at South Yarra, and the fourth boring machine, Alice, is due to begin work on the second tunnel from the site under St Kilda Road in the next few weeks. This is creating 7,000 jobs over the life of the project. The Metro Tunnel is a critical piece of the puzzle in keeping Victorians in work and the state on track for economic recovery. In Sydney, major construction work is underway at Central Station as part of the Sydney Metro project in the biggest upgrade of the city's busiest railway station in decades. 2 underground metro platforms are being built as part of the upgrade, as well as an underground concourse that will help commuters move between the light rail, trains, the metro and buses. New South Wales Transport Minister Andrew Constant says it is fortunate that work can continue during the COVID-19 pandemic. He says more than 5,000 people are currently working across the Sydney Metro City and Southwest project, and by the time the project opens, around 50,000 people will have worked on it. The upcoming Sydney Metro West project will support 10,000 direct jobs and 70,000 indirect jobs. Now, still in New South Wales, and the $4.6 billion Snowy 2.0 project tops a list of 24 projects being fast-tracked for assessment under New South Wales plans to stimulate construction, lift the economy out of the COVID-19 triggered recession. Other projects ticked by Premier Gladys Berejiklian's government for rapid 4-week assessment include a $1.5 billion redevelopment of the Mount Druitt CBD and Stage 1 of Ivanhoe Estate, which is Fraser Properties' $300 million project in Macquarie Park with lots of new community dwellings, as well as 480 market dwellings. The New South Wales Premier says by fast-tracking assessments, we will keep people in jobs and keep the construction industry moving as we ride out the pandemic and set our sights on economic recovery. Other projects that New South Wales is announcing, worth a total of $7.5 billion in construction costs, include a $285 million program of works by power utility Transgrid, as well as new schools in Meadowbank, Schofields, Liverpool and Warnervale on the Central Coast, a $24 million recycling plant for Visy Industries in the City of Sydney, and a $24 million upgrade to Bricksworks Horsley Park plant in Sydney's west. In Queensland, thousands of jobs will be created as work begins on billions of dollars of major Gold Coast infrastructure projects. Early works on the $1 billion M1 upgrade between Varsity Lakes and Toogan on the Gold Coast and the light rail extension to Burleigh Heads have begun, while a business case is being developed for the multi-billion-dollar Coomera Connector project in the city's north. Also in Queensland, developers have lodged an application for stage 4 of a $100 million master plan community in Brisbane's north. Summerlin Estate at Banyo is expected to house about 500 residents with a mix of 206 townhouses and apartments when completed in about 5 years. Stage 1 of 6 was completed in 2017. Also in the north of Brisbane, Woolworths says it's recruiting about 200 new staff for a new supermarket in that area in the north of Brisbane. It's about 2 months away from opening a new full-line supermarket and BWS at Dacabin near North Lakes. The complex also has a separate retail component which is expected to open in October with a medical centre, dentist, pharmacy, gym and hairdresser, as well as dining and takeaway restaurants. Now, looking at some of the activity in the very busy resources sector, BHP wants to vastly increase its shipping capacity at Port Hedland in Western Australia in a move that could boost Australia's annual export income by nearly $5 billion and provide more than $350 million in extra royalties for the Western Australian government. BHP says it wants to lift its licensed shipping capacity at the world's biggest bulk commodity export port in what could be a big boost for the Western Australian economy. The company is reportedly eyeing a 40 million tonne per annum expansion, which would lift its capacity from 290 million tonnes per annum to 330. Now, I want to quickly look again at the way media misleads with its style of reporting, because that's what these broadcasts are all about, providing a counter to that. Now, there was a headline yesterday in one of the Fairfax newspapers, of course, Fairfax again, the Age newspaper in Melbourne, which said house prices could dive 30% in severe downside scenario. The article started by saying house prices could tumble by a cumulative 30% over this year and next under the most pessimistic scenario unveiled by National Australia Bank. So that was the newspaper's treatment of it. But what did NAB actually say in its report? Well, it actually presented a number of scenarios, and the bank's base case scenario, the one that it considers to be most likely, assumed that house prices would fall by maybe up to 10% this year, along with a sharp increase in unemployment, before property prices would recover next year. And that's a fairly reasonable forecast, in line with what a number of other credible forecasters are suggesting. But the newspaper chose to focus all its attention on the bank's worst case scenario in the event of a severe and prolonged economic downturn worldwide. In that rather unlikely scenario, the bank suggested house prices could fall as much as 20% this year. It said the severe downside scenario assumes that you get a very significant reduction in global GDP, therefore demand for Australian goods and services offshore and exports would fall, and that would clearly drive unemployment up, and you could have a potential impact on house prices as a result of that. But again, this base case scenario, in other words, the one it considers most likely, is for a shorter downturn and a much more moderate drop in house prices. But as I said at the beginning of this broadcast, to date, house prices haven't fallen. And keep in mind that the first major share market meltdown was on February the 20th. So we're almost 10 weeks into this virus-induced economic crisis in Australia. And also remember that at the start of April, many of our major news media outlets claimed that the price growth in March was irrelevant and that we would see big falls in April. Well, we haven't. And here's what Eliza Owen of CoreLogic says. She says, so far, the COVID-19 downturn has had a dramatic impact on agents' activities and listings volumes in residential real estate, but the value of dwellings has been relatively resilient. She says it's still likely that property values will fall amid the downturn, but the decline in momentum across property values has been mild relative to what we've seen happening in market activity. She says that in the 28 days ending April 21, the change in value was still positive with a 0.4% rise nationally. And she says it seems hard to digest that property values have not plummeted, noting everything that's happening in the broader economy. And she says, with large losses in jobs and hours work, the same level of income is not available to service high housing debt. This would presumably mean more people having to sell property or a larger volume of distressed sales. But as yet, there is so far no evidence of that. real estate continues to show its resilience despite everything. Bye for now.